Hi everyone, welcome to this month's September monthly roundup. I hope everyone's well and has managed to keep their sanity throughout working from home for another month. My name is Matt Greenwood and I work on the corporate FX dealing desk at Moneycorp. I'm going to talk through the various news articles that have happened throughout September, and I'll also touch on the news articles that will happen throughout the rest of the next year and how they could potentially affect the markets. We've seen that the annual number of COVID cases have broken through 1 million deaths, and then we've also seen that 33 million cases globally. Firstly, I'd like to go through the majors, the highs and lows throughout September. So starting with sterling dollar, we saw a high of 134.82, which is actually also a 2020 high, with a low of 126.75. This is an 8-cent trading range throughout the month, showing an incredibly volatile month for sterling dollar. Secondly, sterling euro, we saw a tighter range of trading with highs of 112.79 and lows of 107.62. And lastly, euro dollar, we saw a notable barrier breaking of 120, which is the first time in 20 months that we have seen this happen. Euro dollar reached a height of 120.11 and 116.12. So following on from Jack's update in August, various other countries were added to the UK quarantine list, including various countries in Europe. This would mean that on return on holiday for UK citizens, we'd have to stay in quarantine for 2 weeks, whilst not seeing anyone and staying within your household. Start of September also saw children return back to school, which for some of them was the first time in 6 months that they had actually been back to school due to lockdown measures starting in March. September continued with US dollar weakness, and we saw both cable and US euro dollar reach 2020 highs within the first couple of days of 134.82 and 120.11. This was approximately 8% higher than it was in February, respectively. The beginning of September also saw the S&P 500 close on the 1st of September 1.5% up, and also this was the record height of the S&P 500. This also saw tech giant Apple overtake the entire FTSE 100, becoming more valuable than the entire index accumulated. Also, the reason for the heights in the sterling dollar, because the UK nationwide house price index was announced at 3.7% in August, which exceeded expectations. This was the largest gain in house prices since 2004, as a temporary break in stamp duty and pent-up demand due to lockdown filtered through the market. However, economists are predicting that the housing market will begin to slow down once government support measures currently in place, such as the furlough scheme, are brought to an end. Off the back of this information, there was some Eurozone data which showed that the Eurozone actually slipped into deflation for the first time in 4 years. Adding insult to injury, figures showed that unemployment in the Eurozone had risen to 7.9% in July. This saw the euro slip down to 118 against the dollar and sterling euro rise to 111.54. However, in positive news for the Eurozone, President Macron of France unveiled a €100 billion fiscal stimulus bill, which earmarks 35 billion euros to make the economy more competitive. Also 30 billion euros for investment in environmentally friendly energy products, and 25 billion euros to support jobs, similar to that of the furlough scheme. The dollar then actually began to rise, along with other safe havens, after President Donald Trump pledged to scale back economic ties with China, a striking contrast to Joe Biden, his fellow competitor in the race to the presidential election in November. During the White House news conference, he threatened to punish any American companies that create jobs overseas, as they pay a big tax to build someplace else and send it to our country. Trump stated that if Biden wins the election, China will own the US. Subsequently, Biden turned the argument against Trump, accusing Trump of being soft on China to secure a phase 1 trade deal in January, and only blaming China after his administration lost control of its domestic coronavirus outbreak. So sterling had started the month off strongly against both the euro and the dollar, But rising fears over a no-deal Brexit saw 5 consecutive falls for both the sterling against dollar, and saw it drop towards the 130 mark, having been almost at the 135 mark. It also saw sterling drop below the 110 mark against the euro. News that was published that Boris Johnson's government planned to override parts of the previous withdrawal agreement with the EU. Michel Barnier issued warnings at the back of this that could cause Brexit trade talks to collapse. This is obviously why the pound dropped against both the euro and the dollar. Obviously, Boris announced that we had to negotiate a deal by the 15th of October, otherwise it would be very unlikely that we would leave the European Union in December with any sort of deal whatsoever. So time is of the essence, and we are running out at the moment. So Boris Johnson ordered the redrawing of the withdrawal agreement because he wants British ministers to have the right to interpret key parts of the Northern Ireland Protocol. He wants to ensure Northern Ireland businesses do not fill in the export summary declarations when sending goods to Great Britain. He also wants to strictly define the application of the EU state aid rules in Northern Ireland. Jonathan Jones, off the back of this news, decided to resign from his position due to a dispute with Downing Street over its plans to challenge parts of this Brexit withdrawal agreement. If a no-deal Brexit is the outcome of the UK's departure, various analysts are predicting parity against the euro and sterling dollar to drop back to the 2020 lows of 115. So there's further negative news surrounding the UK, with up to 3.5 billion furlough claims seeming to be fraudulent or paid in error. The furlough scheme has cost the government £35.4 billion so far, with the HMRC looking into approximately 27,000 high-risk cases where they believe a serious error has been made in the amount the employer has claimed. Moving on from this, there was positive news to follow, with the UK consumer spending in August exceeding last year's level for the first month since the coronavirus lockdown began. It was actually up 0.2%, which is up from 2.6% contraction in July. This was helped by the Help to Eat Out scheme, which saw an annual expansion of 9.3% in pubs, restaurants and bars. Additionally, clothing expenditure returned to growth for the first time since February, while sales in the supermarket remained strong, up 14.9% over the same month last year. However, some sectors were still depressed, including leisure, hotels and accommodation, due to social distancing measures remaining in place. The most staggering figure, though, was definitely the airline and travel industry, reporting spending down 61% in August compared to the same month last year. This is obviously off the back of the information and quarantine measures needed to take from visiting countries in Europe. So the figures are down 61% because a lot of people in the UK are not wanting to travel elsewhere in Europe due to the fact that they'd have to quarantine for 2 weeks on return. People have work and various other commitments, so they're not wanting to travel, and this has seen the airline industry see a 61% decrease in expenditure. Furthermore, with a worrying increase in the number of COVID cases, there had been 10 consecutive days of over 2,000 new cases. Boris Johnson also introduced the new rule of 6, in which individuals gathering in groups of more than 6 will be in violation of the law and risk being dispersed, fined and possibly arrested. These fines started at £100 and could go up to potentially £10,000. And due to the nature of this, we saw the pound drop to 128 levels and against the euro down to lows of 108. As September progressed, the Bank of England decided to keep both quantitative easing and interest rates unchanged. Analysts were worried that interest rates were going to become negative, but actually they remained at all-time lows of 0.25%. They did, however, announce that they will begin considerations for negative interest rates with the Prudential Regulation Authority for the last quarter of the year. So off the back of this, this is where we saw lows against the dollar of 126.79 and lows of the euro of 107.62. Analysts are also anticipating an increase to the central bank's quantitative easing programme, with an extra £100 billion likely to be announced at the Bank of England next rate set meeting in November. After this Bank of England meeting, there was a Fed meeting in the US. During the Federal Reserve meeting, the Fed chairman, Jay Powell, provided fresh details on the US central bank's plan to allow for inflation to run above its 2% target in order to make up for periods of undershooting it. Throughout the lockdown period, we've seen inflation rates in the US well below 2%. This is why this needed to change. On the 21st of September, Boris called for another lockdown announcement. This has seen the Prime Minister take a U-turn to make people work from home rather than go into the office as COVID cases continue to rise. All pubs and restaurants will need to shut at 10 p.m, he announced. All schools will remain open as children have too much time away from school already this year. The minimum fine for breaking COVID rules rose to £200 from £100 and could be as large as £10,000 still. Also, plans for fans to return to sporting venues in October had also been postponed, for taking massive hits for various sporting industries in the UK. Local lockdowns will also be introduced in various parts of Wales, Scotland and Northern England, and there could potentially be more in the upcoming months. Boris has said that these restrictions will remain in place for the 6 months over the winter period. This has led to many restaurants and bars complaining that they will not be able to survive this longer period shutting at 10 p.m, as they believe they'll lose a huge amount of business, having lost a huge amount in the 3 months that they were shut earlier on in the year. Weddings will also be reduced to 15 people, however funerals will be allowed to have 30. Separate households will no longer be allowed to visit indoors in Scotland, and this saw sterling fall further back down to its 126.80 levels, and also 107 against the euro. On the 25th of September, UK borrowing in August soared to £35.9 billion, which is actually £30.5 billion more than in August 2019. The government has actually borrowed £173.7 billion between April and August, a record. Sunak then confirmed plans to scrap the £39 billion furlough scheme when it's due to end at the end of October. It should be replaced by a German-style wage subsidy plan, and this has presented employers with a decision within weeks on which jobs where employers work reduced hours. So what does this mean? This means that the taxpayer will no longer pay part of the wages estimated that 3 million employees who could not work. Instead, the Treasury would only step in to subsidise people who worked at least a third of their usual hours. This winter economic plan could cost up to £10 billion over the next 6 months. And under the new job support scheme, the government will help subsidise jobs where employees work reduced hours. Employees unable to work any of their normal hours will not be eligible. So those eligible for the job support scheme will receive their pay for hours worked from their employers. And for the remaining hours, the government and employer pay 1/3 of the wages each, while the employee will forgo the final third of their wages. Companies would also be able to claim a £1,000 job retention bonus announced by Sunak in July if they bring people back from furlough scheme and keep them on the books until the end of January. The Chancellor also announced to MPs that restaurants, hotels and cinemas would continue to pay 5% VAT as opposed to the 20% they normally pay until March 31st next year. This would be at an estimated cost of £835 million. In terms of going forward, there is a 3-day negotiation going on between the UK and the EU. And with Boris announcing that a deal needs to be arranged by October the 15th, it is an important couple of weeks for sterling. Furthermore, with the furlough scheme coming towards an end, it will certainly be interesting to see whether unemployment figures skyrocket or whether the scheme has actually done its job of saving redundancies. We're at all-time high of unemployment levels, so it would be very interesting to see where it goes with the new plan of wage subsidy. So in the US, the main talking point is certainly the US election. Will we see another 4 years of Trump, or will Biden manage to become the 46th US president? We are expecting a huge amount of volatility on the door, as polls suggest that the race is extremely close. Lastly, with the Northern Hemisphere going into the winter months, COVID is at a critical point, as we saw 10 out of the 12 most infected countries to date in the Southern Hemisphere. Viruses tend to prefer cooler temperatures, so it's a vital time for UK, US and Europe to ensure that the number of cases does not spiral out of control. These additional features put into place with regards to the Rule of Six will hopefully help the UK in containing the number of cases in the UK. So that's it from me on the September monthly roundup. Please look out for our October monthly roundup. And if you wish to receive daily, weekly or monthly updates, please get in contact with us or visit our website, or alternatively, our details are in the comments section below. Thank you for listening. I wish everyone for the best for the rest of 2020, and please stay safe.